Good morning, ladies and gentlemen. My name is Greg McCloskey from ForexLive.com with the late Forex technical report for October 10th, 2022. Adam worked the night shift for Eamon last night. Eamon worked the London shift for Justin, and I'm taking care of the New York shift here today. So a little shuffle, and that caused us a little bit of tardiness for the Forex technical report this morning. I'm sorry about that, but let's get into it. Please ignore this Band-Aid across my nose. I lost a battle with the lid of a garbage bin, which came down and smashed me in the nose. Thankfully, it's not broken or no stitches, stuff like that, but did cause some bleeding. But I will be okay. The other thing is I'm wearing my headset because, again, Adam is off, so I'm listening to some headlines to make sure that I don't miss any key economic or headlines coming out of the market. So let's start by taking a look at the euro versus US dollar and what we saw on Friday, which is key because it sets the stage for risk levels, the bias, so on and so forth, is that the price off the employment report moved down. We fell below this swing area through here. You can see the swing highs and swing lows during that in that area, and the price rebounded. But where do we rebound to? We rebounded right up to the 200-hour moving average, found sellers against that level, and closed near the lows for the day. The price action and trading here today. So in the Asian session, a brief bit move back up toward the high of that swing area near the 0.97506, moved just above that level, and found sellers, willing sellers, pushing the price down toward this swing low, this swing high right here. We're into the extreme area down here, but below the 61.8% retracement as well. Close risk. Don't want to get above the new high for the day. Don't want to get above the 97.50 level. Stay below that level in the short term keeps the bias more to the downside for the euro versus US dollar. If we move above that level, then we look back toward the 50% retracement, which was this low on Friday before the market moved higher, and then the 200-hour moving average. For the week, we don't want to see the price move above the 50. We don't want to see the price move back above the 200-hour moving average. We want to see the price stay below this level because that's the bias. That's what is showing us right now. So resistance, resistance, resistance on the top side. If we move above that level, all bets are off for the medium, longer term view of the euro versus US dollar. On the downside, get below these areas right here, and then we start to look toward the low price from this date right here on September 29th, and then we'll be looking toward our low prices for the year, which are way down here at the 95.35 level. So that's a euro versus US dollar. Let's take a look at the pound versus US dollar. We're seeing up and down price action and trading here today. On Friday, the price did move back below its 200-hour moving average as well, but found support near the 38.2% retracement in trading here today, trading above and below that level, that key target that we need to get and stay below in order to keep the bears more satisfied. If we're able to do that, then we'll look toward the 50% retracement, which is joined by this swing high, this swing high, this swing high, moved above it and stayed above it through here. So this is the extreme down here, and that getting down to that 50% retracement would be our next key target on the downside for the sterling versus US dollar. If we break below that level, it opens the door for further selling. What don't we want to see in the pound versus US dollar? And that would be a break above the 100-hour moving average. It is rising to the upside here as a result of this rally here. But with the decline here, it may start to flatten out and start to go sideways. That currently comes in at 111.59. So stay below the 200-hour moving average this week. Keeps the bears more in control for the sterling versus US dollar. Right now, sellers are trying to keep the price below the 38.2% retracement, which is really, really short-term risk for traders, intraday traders, let's call it. If we stay below that level and start to build below this level at 1.1019, that would increase the bearish bias and have traders looking toward the 50% retracement. Take a look at the dollar versus yen. It remains above the 145 level here as traders take on the, not necessarily take on the Bank of Japan because they haven't come in. We haven't seen the intervention. We haven't seen any sort of verbal intervention as well, at least for now. So we will. But it is above those levels that the Bank of Japan did come in. They came in up here at 145.90, I should say. They came in here verbally at 145, and then they actually came in here. But this was during rate rises and the Bank of Japan keeping rates unchanged. So the market was sort of moving fairly quickly here to the upside, as you can see, but then fell 500 pips to the downside. Bank of Japan may be satisfied with the steady decline in the yen, and it's hard to ignore the fundamentals as well. They might feel like they can't really take it on right now, especially in light of the things like the unemployment rate and the statistics coming out in the U.S., which continues to show strength, which is hard to keep the dollar down, especially against the yen, where the Bank of Japan is keeping rates unchanged. So they may be losing a battle, and they may be giving traders the go-ahead to push the dollar yen further to the upside at a measured pace. They don't want to see big moves really quickly. They may come in if that should happen. Whereas risk now, traders don't want to see the price move below this yellow area or the 100 and 200 hour moving average on the downside. The dollar versus Swiss franc is moving to new highs, breaking above the swing highs from the month of September through here and here, and also above the early October high through here. So extending to the upside. What does that look like on the daily chart? This is what it looks like. The next targets come against the high prices above the above the parity level, where we are testing the parity level right now at 0.9998 as I speak, I should say. And then above that, we have the par 49, par 61 level. Those were our high prices going back to May and June of this year for that currency pair. The dollar versus Canada is remaining choppy here. Here we developed a ceiling on Thursday and Friday, and we kept that ceiling in place here today, up at near the 137.61 level. Get above that level, we'll be more bullish. Stay below that level, and we're battling between the 200-hour moving average below, which held support on Friday, and the swing area above. So this area right here is our trading range. If you like to sell the dollar versus Canada, go ahead, lean against this level right here. If you want to buy the dollar Canada, go ahead right here with a stop probably below the 100-hour moving average below that level. But the buyers remain in control above the 100 and 200-hour moving average, but have the ceiling to get to and through. On the top side, we have our swing highs between 138 and 138.636 on the top side. So there you have it, a look at 5 currency pairs to get the technical picture going here for you this morning. Sorry about the delay. My name is Greg Mikulowski. Good fortune with your trading. Bye-bye now.